Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
There's always in a given week 2, 3, 4 research reports that stick out. A couple days ago, George Saravelos put out an absolute jewel of Deutsche Bank information, bursting stereotypes on all that's going on tariffs, international dynamics, economics, and of course, you know, the whole debate here that we have. He joins us now from Deutsche Bank. George, thank you so much for being with us. Figure two, no one knows this, including the President of the United States. If you take out our addiction to Canadian oil and gas, we run a trade surplus with Canada?
Yes, the US does if you exclude energy. And I think one of the challenges in thinking through about tariff risks is the economic impact. And if you compare the economic impact of tariffs on Canada versus, for example, China on the US, it would be far larger because Canada has a bigger capacity to retaliate. There's a reliance on energy that creates inflation. So the market is questioning how much President Trump will go ahead with the tariffs he's threatening on Canada as soon as February 1st.
Does the
and it's going to be a learning process.
Does the x-axis matter? Is the timing important? Like they want to tranche it out, or is all in one big one or that? Does that matter to George Saravelos?
I think, well, what matters to me is what impacts the market. And if you look at the price action this week in the market, what was interesting, and it's something we had warned about the previous week, the market was expecting an immediate tariff announcement. You could see it in the risk premium that was priced in to the volatility space. You could see it in inflation break-evens. And therefore, when tariffs were not announced on the first day of President Trump's new administration, you have seen the market squeeze in terms of the dollar longs. Now we're entering next week with almost the opposite dynamic. The market has completely taken out the risk premium of potential immediate tariffs, especially with regard to Canada, and that would be a big shock.
I mean, I figure 9, Paul, this brilliant research report. Folks, we protect the copyright of our guests. You're not going to get it from me or Paul. Go to Deutsche Bank to get the Saravelos research. The U.S. imports more oil from Canada than all other countries combined.
I did not know that.
I mean, that's what you get from Saravelos.
Saravelos. Yeah. So, George, in your market, in the currency market, how have traders been positioning themselves for a world where there may be higher trade tariffs, you know, not just Canada and Mexico, but kind of across the board?
So this is really the key question for the market and the big driver this year so far. It's what I would call the tariff risk premium, how much of that risk premium is priced into the market. And traders have been positioned for some probability of tariffs going ahead. I think what we saw this week was just how aggressively people were expecting immediate tariffs, and that is why we're seeing some reversal of recent trends. But if you're looking at the cumulative amount of tariffs that are priced in, especially after the retracements we've seen this week, you're actually not seeing that much. I would say the market is at the very lower end, if not below the lower end of what is a reasonable range of tariffs going forward. Right. And that's really the reason why we still see the risks are skewed towards more in terms of dollar strength, because the market at the moment, I think, is underpricing the full extent of tariffs that could materialize.
In this hour across the nation on your Friday on YouTube, again, subscribe to Bloomberg Podcast Building each and every day, including the weekends. There's a lot of podcast watching during the weekends. George Saravelos with us. We continue. He is with Deutsche Bank. Coming up, Sarah Hunt will talk equities with her. Paul?
George, is there any reasonable bear case for the U.S. dollar? I just don't see it out there, and I haven't for the longest time.
You mean a reasonable case for the dollar to weaken or to strengthen?
Yeah, just kind of a bearish case for the U.S. dollar.
So I can give you a historical example. When President Trump started his first administration, the market was also expecting dollar strength, and you saw two things happening. You saw any progress on fiscal and tax reform stall for 9 months as the administration was trying to repeal Obamacare, and you saw a big upswing in global growth. I think if you saw a repetition of that, the dollar would most certainly weaken. But what we're seeing this time is the administration picking up pace. The immediate focus is on tax cuts, it is on trade, and the global environment looks a lot more challenging. So I can always build a bearish case for the dollar, but from my perspective, I think the hurdle is much higher than what it was in 2019.
The news flow is extraordinary, George. I got to do an audible here. Just in the last 12 hours, 18 hours, the president has reverted in Fed speak, and I think indirectly in currency speak, to what we knew Donald Trump to be, which is he likes lower interest rates. I mean, he's a real estate guy. Which real estate guy, Paul, doesn't like lower interest rates? Introduce him to me sometime. George, the president wants lower interest rates from Chairman Powell. I believe he stated at Davos he is going to lower interest rates. Let's just begin with that. With your Cambridge economics, can a government leader force interest rates lower?
If the Fed is independent and this institutional independence is maintained, then the answer is no. The transmission would work via Fed appointments, but then if you're looking at the Fed appointment process, which requires Senate confirmation, and also the number of Fed governors that are up for reappointment, there's not that many.
Yeah.
But what I would say, going back to the question around the bear case for the dollar, the single biggest risk would be a compromise of Fed independence. We certainly don't see that from our perspective, because I think the administration is well aware that if that was to happen, it would lead to all sorts of other bad things happening. For example, yields going up rather than down, especially in the back end.
Exactly.
But I think it's for that reason that the commentary is likely to remain verbal rather than genuinely impacting Fed policy, which is what we saw last time.
And Governor Lucetti will straighten that out. One final question, George Saravelos. The president wants a weak dollar. He's been that way since before he was president as well. How far are we from the tension of the Plaza Accord, where there was a primal scream for a weak dollar?
So you raise a very interesting question, Tom, because by this time in the first administration, we already had the Secretary of Treasury nominee Mnuchin talking down the dollar. We had tweets from President Trump talking down the dollar. And this time, what I'm seeing is something very different. I'm seeing Scott Bessent in the Senate testimony hearing talk about the importance of the dollar as a reserve currency. I'm not seeing Trump talk about the dollar all that much at all. In fact, I think he hasn't even mentioned anything since the Bloomberg interview he gave way before the election. I think the reason behind that is the administration is realizing a strong dollar helps keep US inflation down. And therefore, from that perspective, it's one of the few things that I think is different from the first administration, that they're actually less keen on a weak dollar to help U.S. inflation come down.
Got to run. George Saravelos, congratulations for the research piece of the week. Just absolutely outstanding. Mr. Saravelos at Deutsche Bank.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Sarah Hunt joins us now on the equity markets. Are you surprised at the day-after-day bid of the market?
I'm not really, because what we're looking at right now is, again, all the optimism, and people are putting the pessimism or the things that might go wrong aside. Because
of earnings or Washington?
So Washington, but earnings have helped, right? So earnings helped a lot. The banks needed to come in with good numbers. They did. If we can see earnings come in good, that's going to go well.
Because it seems like 2025, if this market's going to move higher after 2 years of 20% plus returns, and a Fed that's probably not going to be that active in 2025 in terms of lowering rates, earnings really have to drive the story here. Are you confident in a 11, 12, 13% growth in S&P earnings?
It depends a lot, again, now what's going to happen with technology, right? Okay. You can look at the energy sector and go, okay, oil prices are higher. That's going to help earnings for the S&P as a whole, where last year it was a detriment. There are going to be areas where you need to see that growth coming through, because where the multiple is, it's hard to see multiple expansion. You need to see that earnings grow into that so that you can see that market move higher.
One of the sectors that has been I guess, a Trump trade kind of sector is financials. The expectation that the regulatory environment is going to ease. If nothing else, that would be beneficial. Do you ascribe to that? Have you guys stepped up your exposure to financials?
I wouldn't say that we've necessarily stepped it up because we had representation there and basically a lot more in the larger banks because I think there may be some issues with the regional banks. But I think that just the fact that you may see an M&A boom after you've got a change at the FTC might help on the financial sector because you have a lot of smaller banks. I think that what the market is looking for is a change in the tone both from a regulatory standpoint and from an M&A standpoint.
I guess with this new administration, there's been, I think, a palpable sense of economic optimism. I'm not sure if it's animal spirits is the right word, but people feel like this is an administration and a government that is pro-business, pro-growth. If that's in fact the sense, is this maybe a time for smaller caps, mid-caps to actually do well?
I think it absolutely is. And I think that, that's going to depend a lot on what happens to the rest of the underlying economic data because for small caps to do well, you need to see a good economy. The fact that the Fed is likely to be backing off a bit here is tougher for small caps because higher rates are tougher for them as a group. But I think that could be, if the U.S. does do well, small and mid should do well as well.
Not once, but twice this weekend, I got grilled on international stocks. And I went back and looked at my Sarah Hunt notes. And the basic idea is they're completely correlated to weak dollar. Am I right on that?
I think it is a much bigger driver than what's going on for them economically. And one of the reasons that you would think they should be less strong is because what's going on in Europe is not fantastic economically, but there definitely is a currency trade-off there. And I think that it's sort of like when the U.S., when interest rates go higher, the tech group goes lower.
Yeah.
When the dollar gets weaker,
How do you digest, and I don't want you to talk about Apple specifically unless you want to, but there's like rumors, OMG, somebody's this or that, there's a shortfall. There are these research geeks measuring things on whatever product. Do you lean over the desk and listen to those people, read those people, or is it just tangential noise?
I think it has to be part of what you're looking at altogether because you don't want to be surprised by some sort of a shortfall, but the market doesn't seem to be enormously surprised. I think it really depends on what else is going on underneath. For something like Apple specifically, that service revenue and that recurring revenue is a bigger part of what people look at in the story. The hardware is still important. So if there's a shortfall and it's not continuous, that's probably not as big a deal.
You're talking Apple. Can I be rude, Paul?
Sure.
Are you going to load the boat on Apple with this pullback?
I'm definitely going to make sure that if I was underweight or not participating and I like the story, I would be adding to it here. We had a participation already.
So,
she owns it.
Yeah, that's fine. That's
Barron's talk. That's the way Mario Gabelli talks.
Nothing wrong with that. We mentioned the Fed before, probably a little bit more quiescent this year than maybe we initially thought. What do you think the Fed will do this year?
That's going to depend on a lot of different factors, but right now I think the impetus is to do nothing, is to sort of wait and pause. We'll see what happens next week, but I think that you're going to need to see data on the inflation side come in reasonably good for the Fed to be able to cut more, just because things are going well enough that it seems contradictory to say we're raising our inflation outlook and we're cutting rates.
But aren't these rates nominal or real, quote unquote, normal? We had this great conversation with Greg Peters at PGIM. I mean, a lot of younger people are going, OMG, it's so weird. Is it?
It's not so weird on the back end, on the long end, but on the short end, that seems a little high relative to other things. Okay. So that could be the argument of saying I can bring the short end down a little bit because we want to see that steeper yield curve and that more normalized yield curve. But yes, after a decade of zero, you go back and look, rates at 5% are almost low relative to history, especially on the long end.
Sir, they're tearing up Paul out on YouTube today, out on live chat. He used the word quiescent.
Oh, God. What's happening?
So, like, when you're courtside at Duke, and the first quarter doesn't go well, do you look there and who's the freshman star, Callum?
Cooper Flag.
Connor?
Yeah, Cooper.
Cooper Flag.
Yep.
So do you go, Cooper, you're quiescent?
Yeah, no, that's not going to happen. I'd get thrown out of my seats.
Quiescent?
Yeah, what's happened to me?
Okay, Lisa, he's ruined.
Yep.
That's all there is to it. Sarah, thank you so much. Sarah Hunt on short notice today on the equity markets as we really readjust with Alpine. Saxon.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Callum Henderson, for years, was definitive in international economics. You get upset. He'd throw out a 12-page wonder, and you'd be, oh, damn, I got to read this. He was that good. He's teamed up with Thomas Harr of the Denmark Central Bank to write a lovely, short, focused treatise on your fear of inflation. Dr. Harr joins us right now, chief economist, head of all of economics for the Central Bank of Denmark, Denmark's national bank. Is this 1960s inflation? Is this the inflation that our parents or some of us older lived, Dr. Harr?
No, thanks a lot for being on the show, Tom. And I don't think it is so. I think what happened, and that's what we talk a lot about at length in the book, is there was these extraordinary shock, and there was extraordinary, you can say, fiscal and monetary policy. A lot of differences between the different regions. We described both the US, Europe, and Asia, but that happened. But what was a key difference compared to the 60s and 70s was, for example, that inflation expectations did not rise to the same extent. And therefore, that was one of the key reasons why inflation came back down. But clearly, there are a lot of uncertainties out there, and have to talk about that.
The heart of the matter in the fear of every sentence of Jerome Powell's press conference is the fear of central banks unanchored. Are we threatened that we could be unanchored in these tumultuous times?
I think, all central banks are monitoring this extremely closely. And clearly, when you look at the last, and that's what the book is about, the 2021-22 burst of inflation, we did see on the short-term inflation expectations that they rise somewhat, but the longer term still was, you can say, surprisingly or at least noteworthy resilient. But we are monitoring this extremely closely to see whether there are any signs of de-anchoring. But so far, they are not, in my view. And that's also what we talk about in the book.
Thomas, the discussion these days, just in the last week or so here in the U.S., has been about tariffs. From your perspective, what is their impact on inflation? How do you think about that relationship?
No, I think there is a difference between whether you look at it from a U.S. perspective or whether you look at it from a world perspective. But because one of the points we're actually making in the book is that inflation is to a very large extent a global phenomenon. But I would say, and that's always a danger of saying this time is different, but I think if you look at the tariffs issue, I think it's very difficult to not see it as at least short-term somewhat inflationary for the U.S. And by that way also some of the other things which could come out of the new administration. But I would say in terms of for the rest of the world, I would say less so, because what it could be, you can say, a negative supply shock for the US in terms of tariffs will be a negative demand shock for Europe and Asia. And therefore, I would say the spillover of that in terms of inflationary, it's very, very uncertain. Of course, also depends on what happens to the dollar. But overall, I would think that it would be more limited in terms of the global spillovers from that than what we saw in 21-22.
Thomas Harr, I would be remiss if I didn't pull an audible here for our American commuters, those on YouTube nationwide. The Bank of Denmark rides herd on all the research capabilities of Greenland. And I don't want to get into a debate about who's going to end up with Greenland here, but I do want to ask simply, what's the number one thing in the Danish Central Bank's research on Greenland that you would like to convey to our American audience?
I mean, we do some analysis on Greenland. We will actually quite soon come out with a new analysis on Greenland. But that you can look out for. I think it will be out in a couple of months, just published from the central banks, purely on the economic outlook for Greenland. We are updating this on a quite regular basis, and that will come out, as I said, in a couple of months' time.
We'll have to have you back on for that. Or I think maybe Paul Spring in Copenhagen. Sure. Thomas Harr, thank you so much, and congratulations on your book with Callum Henderson, The Inflation Resurgence. We greatly appreciate it today. Dr. Harr is with the Denmark Central Bank.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
A daily look at the front pages, the Lisa Mateo moment, and now the Yak report. What are you talking about?
Okay, cashmere, right? The hottest thing, very expensive, beautiful, feels nice and soft.
Perfect for a birthday.
Yes, but forget about it because there's a new luxury material that you have to be interested in. It's from the yak.
Oh boy.
Yes. You were talking about it. What
This
the heck
is
is
for
a
men,
yak,
right?
It's for men.
Oh, okay.
It's a cattle. They're known for loud grunting, right? They could probably eat a little cashmere goat. But it's less expensive. The Wall Street Journal points it out. It's still soft. Not as soft as cashmere, but it has a little bit of a manly touch to it. So it's tough yet tender at the same time. So it has that feel
This
to
has
it.
a Dan scarf.
Yeah.
is what
Could be.
this is.
Could be.
Maybe.
I'm looking at the American Trench, the
Okay.
Carl Yak shirt, $249.
Ooh.
Wow. Okay.
Compared to what
A
cashmere
yak
can
shirt.
run you almost $900.
Yep, the Todd Snyder
Sometimes.
knit cashmere overshirt, $998.
There you go, there you
So
go.
Yak is I guess it's just the pedestrian man's
Is it coming
cashmere.
from Tibet?
But they're saying, well, I don't know if it's from Tibet, but they're saying that it offers this like conversational piece because you're at a party and you can say, hey, my shirt's made from yak. No, it doesn't work?
No.
All
right.
Next.
I'm trying. Okay, President Trump moving back into the White House. He sent the D.C. luxury home market. It's on this buying spree right now because more people want to be his neighbor. So you have business leaders, new members of Congress, wealthy political appointees. They're all scooping up these like multi-million-dollar properties in D.C. and some of those surrounding neighborhoods. So I'll give you an example. December, Cantor Fitzgerald CEO Howard Lutnick, he's the president's pick for Commerce Secretary. He set a record for D.C. He paid $25 million for a home there. Also on the hunt, you have Treasury Secretary nominee Scott Bessent. He's looking for a home there. But the real estate agents, they're just saying that these are like big ticket deals that's really taking off faster than in any prior administration. You know,
In the
since he
D.C.
started.
metro area, there were 87 home sales above
Okay.
$5 million last year, compared with 53 in 2023 and 16 in
See,
2026.
so the prices
Wow.
are just soaring.
Sure.
They're going
All
up
right.
because of that, because people want to be
I like the
around
Georgetown
him.
area. I could live in Georgetown.
There you go.
Georgetown is like $8 million to get
I know.
to slide
It's
into
always been
something.
good. Yep.
Oh, so is their
Unreal.
university.
Yes.
Next.
Check that one out. So if you have an old iPhone with TikTok installed on it, people are paying you big money for
Why?
this.
I saw this.
Okay,
Why?
yes.
I
The
don't
reason
get it.
because is the app is still not on the App Store. So when TikTok went down and went black and it's on Saturday,
It's not on the App Store.
it's not in the App Store. So people started deleting it once it went down on Saturday. But now they can't get it back up because it's not on the App
They
Store
can't
anymore.
re-download it.
They can't. They can't get it, and they need their
So
TikTok.
is TikTok still dark?
No,
Or-
it's not dark anymore.
It's not. So-
It's back up and
All
running.
right, good up and running. Good for
But
the
you
TikTokers.
can't get it
If
if
you're
you want to go in the
addicted
App
to
Store.
it, you buy an old
If you
iPhone.
buy an, can I tell you how much they're going for? They're selling on Facebook Marketplace, Poshmark, eBay, $3,000. One guy even said he paid $5,700.
Well, if that's your business, if that's your business, being a influencer or content creator, you got to be there, right?
If you deleted it, then you're stuck.
Yeah.
But
All right.
but people are saying, you know what? Don't do it because they can have some spyware in there. You could be in trouble. They're saying that there are safer options. You can go to web browsers. They still have it on there. Reddit, people on Reddit are saying there's like a workaround to the app. There's always some kind of workaround. But it's a good way to make money if you have an old iPhone with TikTok.
Lisa Mateo, thank you so much. Our newspaper report today.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.